Hi everyone, so welcome to the live stream today. Very much excited for having you. We are continuing with our IFRS masterclass, and today it's going to be section 2. Yesterday I discussed with you how to study the IFRS and the accounting standards and how you can pass the examination. We discussed the basic accounting standards that we need to focus on, the non-current assets accounting standards, and the various other accounting standards that you must know in order to position yourself strategically to pass the examination, and most importantly, take your life to the next level. And welcome to the part 2 of this as we continue with the discussion in that case. And today we want to look at the non-current assets accounting standards, which means that we're going to be focusing on a couple of standards. I'm going to taking you through the non-current assets accounting standards. So the non-current asset standards, that is, we're going to be looking at IAS 16, property, plant and equipment, IAS 20, government grants, IAS 23, that is borrowing costs, IAS 40, investment properties, and then IFRS 5, held for sale and discontinued operation. Held for sale and discontinued operation. So this is going to be the basic standards that we're going to be looking at in the accounting standards, and we're going to be solving questions as well from the ICA question kit. You know, if you're a follower of my work, I've told you that you need the ICA question kit, so you make sure that you grab it, because if you already have it, stay tuned with me, because we're going to be solving questions from the question kit as we prepare for the exams. I see some of you coming on the stream. Welcome to the stream. When you join the stream, give us a thumbs up on the video. That way we get more engagement on the video, and YouTube will be able to push the video so we can reach as many students as possible. But most importantly, I want you to also comment in the chat box any questions you have for me, what standards you would want us to cover, and anything that you want me to share my thoughts on. Put it in the chat box. I want to hear from you. And also remember to share the video with your friends, with your colleagues, on your WhatsApp pages, on your Facebook pages, so we can get many students coming on the live stream to be able to watch it and help many students across the country. So together we can all become more successful in that case. So these are the IFRS standards that we're going to be looking at, and we're going to be paying close attention to and focusing on as we start our discussion in the IFRS masterclass. Yesterday, we started with a part 1 where we looked at how you can study the accounting standard. And in case you missed that, I'm going to drop it in the description to this video, so you'll be able to watch that as well, and stay tuned with us on the series as we continue with our discussions in that case. So let's begin the journey with the first aspect, and that is what we're going to be looking at off the bat, and that is the IAS 16. Is the basic accounting standard that we're going to be looking at, and then focusing on in relation to what we do there. Now, remember that for each accounting standard that you pick, there are a number of things that you must take into consideration. So let me take this out and then bring a screen up in that case. So there are a number of things that you need to understand. Number 1 has to do with key definitions. Okay, that is very, very important. When you pick standards, key definitions are very, very important. Not only that, we need to also know the objective of the standard. At the end of the day, what is the standard about? Then you need to know the recognition criteria. This doesn't work on all standards, but most of the standards, the recognition criteria are very critical in relation to that. Then we will come to the initial recognition there for the standards there. Aside that, we're going to come to the subsequent measurements. Then you will come to the issue in relation to disclosure requirements. So when you pick the accounting standards, these are a couple of things that you need to take into consideration of the bat in that case. So you need to ask yourself, what are the key definitions I need to know when it comes to this particular standard I'm learning? What is the objective of this standard? At the end of the day, what is this standard about? What is it talking about? What is it explaining? What is it telling me that I need to know about? Okay, what is the recognition criteria for the item that I'm going to recognize in the financial statement? And then what is the initial recognition? In other words, how do we initially recognize this item in the financial statement? Then what is the subsequent measurement? So after the initial recognition, what is the subsequent measurement? That is very critical, that is very, very important. We need to know about that. Then most importantly, any disclosure requirement that has to be taken into consideration in that case. So that is going to be what you need to look out for when we talk about the issue in relation to the accounting standard. So key definitions, as we move on with the discussion, the key definitions will be given to you as we move on and build our knowledge in relation to that. Then the objective of the standards, I'm going to be letting you know about that real quick because that is very, very critical. Then the recognition criteria, the initial recognitions, the subsequent measurements, and then any disclosure requirements, you'll be knowing about all of that. I see some of you guys joining the stream. Welcome to the live stream. This is the IFRS Masterclass Section 2. We are looking at the accounting standards, focusing on the non-current assets accounting standards with our specification on IAS 16, IAS 20, IAS 23, IAS 40, and then IFRS 5, held for sale and discontinued operation. So smash the like button if you are getting some values already. Thank you very much. I see some of you guys smashing the like button, and comment in the chat box. Let me know if you have any questions for me real quick in relation to that. So I see Holy T said, hi, sir. Still want to thank you for the lectures on financial management. I was able to use and pass my F9 in September. Wow, that is awesome. Congratulations, Holy T, for passing F9 in September. Hoping that you do best and continue with your discussion there. Happy New Year. You are saying IAS 20 and then IAS 23 as well as IAS 36. That is awesome. I'm going to be covering all of these standards in the discussion. Kofipa Enterprise with a thumbs up in the chat box. Thank you very much, Kofipa. And then Aaron Martins also with a thumbs up in the chat box. Let me know in the chat box any questions you have for me, what you would want me to share my thoughts on real quick. Also remember that we started our lectures for the November 2021 exam. Did I say November? I don't know. I'm already ending November. For the May 2021 ICA examination yesterday, we started lectures yesterday. So you can visit NhyiraPremium.com and at 390 Ghana cedis per paper, enroll and study under my mentorship directly and get access to our course materials and join our Zoom sessions in relation to that. So smash the like button as we begin the discussion in that case. You ready? Let's go. Mafu, Ajay, I see you in the chat. You are welcome to the live stream. So let's move on with our discussions real quick in relation to that. So IAS 16, property, plants, and equipment. Now, the big question we ask ourselves is, what is the objective of the standard? The objective of the standard is simply to prescribe the recognition of assets that are used for business purposes. Now, please note that when it comes to tangible non-current assets, there are two ways that these can be looked at. So, tangible non-current assets, two ways. We have what we call the owner-occupied tangible non-current assets, and then the non-owner occupied tangible non-current assets. Now, when we say owner-occupied tangible assets, what we mean is that these tangible assets or these assets are used in the day-to-day running of the organization. Okay, so in the day-to-day running of the organization, in other words, these assets are used by the organization probably for administrative purposes or for manufacturing purposes or as a sales room or something like that. In other words, the business uses these assets in its day-to-day running. These are called owner-occupied non-current assets. Okay, tangible owner-occupied non-current assets. Then we have what we call the non-owner occupied non-current assets. The non-owner occupied non-current assets. Now, these are non-current assets that the business controls, but they are not used in the day-to-day running of the organization. Either the business is having the assets for lease purposes, or the business is having these assets for capital appreciation. Now, stay with me because I'm going to be dropping a lot of knowledge here that will help you later on as we build our knowledge in this standard. So what are we saying here? When it comes to tangible non-current assets, there are two things you must understand off the bat. One is that we have what we call owner-occupied tangible non-current assets. Then we have non-owner-occupied tangible non-current assets. Now, before we get excited, there are what we call elements in the financial statement that you need to understand. I didn't take you through that because I assume that you know these already. But one of the key elements that I'm going to be defining because of what we are doing, it's assets. So when we say assets, what are assets? In a simple language, we in your KG2, you remember that you were taught that assets are resources owned by the company. That is not the standard definition of assets. Instead, we say that assets are resources controlled by organization as a result of past events from which future economic benefit flows to the entity. So the key word here is control. The key word here is control. Now, control can be obtained through leasing. That is under IFRS 16, when we lease the assets and obtain the right of using the assets, or control can be obtained by or through direct acquisition. So whether we bought it or we leased it and we obtain the right of using the asset as per IFRS 16, once we are controlling the resources, once significantly the future economic benefit in the asset flows to us, that means that we can use the asset and we will say that it is what? Our asset. So what are we saying? We are saying that when it comes to non-tangible non-current assets, two things you must understand off the bat, that it can either be an owner-occupied non-current assets or a non-owner-occupied non-current assets. Again, we said that the owner-occupied non-current assets simply means that the business is using the assets in its day-to-day operations, either for administrative purposes, for manufacturing purposes, or even as a showroom in that case. Now, when the organization is using the tangible non-current assets for the day-to-day running of the organization or as part of the day-to-day administration of the organization, then that asset or those assets will be accounted for in accordance with IAS 16, that is property, plant, what? And equipment. Meaning that the business is using the assets in its day-to-day running as an organization. However, there are times when an entity controls an asset, that is, an entity leases an asset or an entity outrightly purchases an asset, but they don't use it for the day-to-day running of the organization. Instead, they sublet it under an operating lease, or they are holding on it for capital appreciation purposes. For those assets, they are going to be treated as investment properties. Hence, they will be accounted for in accordance with IAS 40, investment property. Are you getting us off the bed? It's very, very important for you to get us off the bed as we begin the journey in relation to that. So listen carefully. Now you are seeing lease here. If it is leased under a finance lease, in accordance with lessor accounting in IFRS 16, then we don't account for it as an investment property. But if the lease is an operating lease, in accordance with IFRS 16 leases, then we account for it as what? An investment property in accordance with IAS 40 investment property. Or the business has the asset, has a land, but has not currently determined the usage of that land or the usage of that property. For that reason, it will still be treated as an investment property in the financial statement and will be accounted for in accordance with, again, IAS 40 investment property. So, off the bat, it's very important for you to understand where are we standing. Is it about IAS 16, the business is using it for the day-to-day running of the organization, or is it about an investment property? Please note Remember the leases I put here, I said it is operating lease. You got to be careful about that. If it is a finance lease, you cannot treat it as an investment property. It is only when it's an operating lease, as per IFRS 16, then we can treat it as an investment property. But if it's a finance lease, then it cannot be an investment property in that case. So you got to be careful about that. So our focus in the next few minutes is to look at the owner-occupied non-current assets, look at the initial recognition, the subsequent measurement, and all of those things, and then look at the various treatment there. Then from there, we will look at the issue about the IAS 40 investment property. Let me know if you are getting some values from the chat. Give me a thumbs up on the video in the chat box. Let me know if you have any questions for me in the chat box real quick as we continue with our discussion. Remember to also follow me on Instagram, because the meeting details and the discussion for each day will be posted on my Instagram page, and you'll be able to get a notification and then prepare to join the live stream Monday to Friday, 4:30 p.m. GMT on the dot. So let's go IAS 16, property, plant, and equipment. Property, plant, and equipment. You ready? Let's go. Now, the objective of IAS 16 is to prescribe the accounting treatment of non-current, tangible non-current assets that are used for business purposes, okay? Owner-occupied tangible non-current assets. So the objective of IAS 16 is to prescribe the accounting treatment for tangible owner-occupied non-current assets of the BET. Now, when it comes to some definitions, we'll be going on with some definitions later on as we proceed with the discussion. But of the BET, we need to find out, okay, what is the initial or what is the recognition criteria for tangible assets? So recognition criteria. How do we recognize tangible assets? How do we recognize it? Now, IAS 16, property, plant, and equipment states that an asset should be recognized when it meets the definition of an asset. Okay? So we will recognize the asset when the definition of asset is met, sorry. So the asset definition is met. So when we meet the definition of an asset, and remember we've defined an asset as what? Resources controlled by an entity as a result of past events from which future economic benefits flows to the entity. So if the transaction meets the definition of an asset, boom, we recognize it. That's the first recognition criteria. Aside that, number two, cost must be measured reliably, or the cost can be measured reliably. Cost can be measured reliably. All right, so it has met the definition of an asset. Good. Can we measure the cost reliably? Yes, that is very critical in relation to that. So the cost can be measured reliably in that case. Not only that, future economic benefits flows to the entity. Are you getting the idea? So future economic benefits from the usage or service potential in the asset flows to the entity. So will future economic benefits substantially flows to the entity? If yes, we go for it. If no, then we cannot go for it in relation to that. So that is the second thing that we need to understand when we talk about the issue in relation to IAS 16 in that case. When we talk about the issue in relation to IAS 16. So number one, we've met the definition. Is it good? Very important. Number two, can the cost be measured reliably? That is it. Then number three, it is probable that the asset will, the future economic benefits in the asset will flow to the entity. It is probable that future economic benefits in the asset will flow to the entity. So three things: meet the definition of an asset. 2, cost can be measured reliably. 3, it is probable that future economic benefit associated with the item will flow to the entity. Does it make sense? So that is how we recognize assets. So that is the recognition criteria of assets. Now, after we do the recognition criteria, then the next thing we need to ask ourselves is, what is the initial recognition? In other words, how do we recognize assets initially? How can we measure the cost reliably? In other words, what should constitute the initial cost of an asset? What should constitute initial cost of a property that has been acquired or a property that has been leased? So let's look at the initial measured cost of an asset. So the standard says that assets should initially be measured, or the initial cost of assets should include, among other things, the following. So initial cost of assets. So among other things, the initial cost of an asset shall include the following. Number 1, the purchaser's price. This is how much we paid for the assets, for the actual assets. How much we paid for the assets, so the purchase price. So maybe let's say we bought a plant from China, and the plant is $300,000. We convert it to Ghana cedis, 300,000, whatever amount we get, that is the value of the property, plant, and equipment. That is the initial, that will be included in the initial cost. So the purchaser's price. Then, now this is how the standard puts it. The standard states that the initial cost of an asset shall be the purchaser's price and other direct costs incurred in bringing the assets to its present use. You want to note that down. If you're writing a note, you want to put that down because that is very critical. The initial cost of an asset shall include the purchaser's price and other direct costs incurred in bringing the asset to its present use. And other direct costs incurred in bringing the asset to its present use. That is very, very critical. So that is the definition for it. So these other costs that we incurred in bringing the assets to its present use includes what? So number 1, we could have any delivery cost. If we happen to procure the thing from outside, probably any import duties. If we need to install it because it's a plant, then installation cost. Then we may have dismantling cost. Please note that dismantling cost will be discounted to present terms. So we find the present value of the future value as per IAS 37, provisions, contingent liability, contingent assets. Okay, so when you're dealing with this dismantling cost or decommissioning cost or removal cost, you discount the amount into present terms, and you do that discounting and account for that item in accordance with IAS 37, provisions, contingent liabilities, contingent assets, and we'll look at that later on. So put this in your mind so that when we get to IAS 37 and I'm talking about the initial cost of the asset, what should be included in the initial cost of the asset, you will be able to what? Catch it there in relation to that. I hope it makes sense. You'll be able to catch it there in that case. Not only that, sometimes we borrow money to manufacture an asset. Now, assuming we manufacture the asset, then the purchaser's price would then be replaced with what is called the manufacturing cost. Okay, so if it is an in-house asset, then the manufacturing cost will come in. All right, so in that case, there may not be import duties, there may not be all of those things there. So depending on the condition under which we are preparing the accounts, that's where you got to be careful about it. Okay, that's where you got to be careful about it. Then sometimes maybe we borrowed money. So the capitalized interest, borrowing cost, would have to be included in the initial cost of the asset. Please note, this borrowing cost that has to be included in the initial cost of the asset should be accounted for in accordance with what? IAS 23, borrowing cost. IAS 23, borrowing cost. So we're going to be accounting for this in accordance with IAS 23, borrowing cost. So what are we saying? If the asset is made in-house, then the manufacturing cost. Now remember, when we say the manufacturing cost, it means that it includes what? The cost of material, the cost of labor, any cost, any subcontracting cost, all of those things will be included in the manufacturing cost. If it happens that we did not manufacture the assets in-house, then the purchases price will come in, delivery cost will come in, any import duties will come in, installation cost will come in. Then if the asset requires removal, dismantling at the end of its economic useful life, we discount that into present term using the cost of capital of the company, and we account for that in accordance with what? IAS 37, provisions, contingent liabilities, contingent what? Assets. Then in case we borrowed money to purchase or to finance the acquisition, or we borrowed money to construct or to manufacture the assets, then the capitalized borrowing cost would have to also be included in the initial cost of the assets. So these, when we add them up, becomes the initial cost of the assets. Becomes the initial cost of the asset. So what should constitute the initial cost of the asset? This should constitute the initial cost of the asset. Please note that under no circumstance would the following be included in the initial cost of the asset. Training of employees shall not be included in the initial cost of the asset. Very, very important. Marketing cost shall not be included in the initial cost of the asset. Very, very important. Any commissioning or branding shall not be included in the initial cost of the asset. Why? Because training cost in its own sense cannot be capitalized. Even if the trainer or the organization tells us that, oh, the people we've trained, they can bring you value for the next 5 years, the standards prohibits companies from actually capitalizing it. Hence, it cannot be included in the initial cost of the asset. It must be written off. Any branding cannot also be capitalized, because whether you brand the asset or you don't brand it, it is ready for use in relation to that. So that will be excluded there. Any commissioning, maybe for us to what I'm saying sometimes works well if you are doing public sector and you're doing Ifrs 17 and you're flipping it over, like you are commissioning the asset. The commissioning of the assets doesn't make it for us to capitalize the cost of commissioning. So that will also not be included in the initial cost of the asset. So what have we discussed so far? 3 things. 1, the objective of IAS 16. We are saying that the objective of IAS 16 is to prescribe the accounting treatment for tangible, owner-occupied, tangible non-current assets. Owner-occupied, tangible non-current assets. 2, we've spoken about the recognition criteria, and we said that for an item to be recognized, for a transaction to be recognized as an asset, it must meet the definition of an asset. Number 1. Number 2, the cost must be reliably measured. And then number 3, it is probable that the future economic benefits in the assets will flow to the entity. If this recognition criteria is met, then we can recognize it in relation to that. Then we come to the initial cost of the asset. What should constitute the initial cost of the asset? According to IAS 16, property, plant, and equipment, the initial cost of the asset or an asset shall be the purchases cost or the manufacturing cost and all other costs incurred in bringing the assets to its present use. All other costs incurred in bringing the asset to its present use. That is what we mean by the initial cost of an asset. Then we are breaking that down into the purchases price, the delivery cost, import duties, installation cost, dismantling cost, and we are saying that that will be in line with IAS 37, provisions, contingent liabilities, contingent assets. And should we borrow money to finance the acquisition or to finance the manufacturing, then we will account for the amount that has been borrowed in accordance with IAS 23 borrowing cost. That is what we mean by the initial cost of the assets. Sounds good? Give me a thumbs up on the video. I see some of you joining. Welcome to the live stream. This is the section 2 of the IFRS masterclass. Yesterday, we discussed how to study the standards, and today we are looking at the part 2. We are starting with IAS 16. I have brought in IAS 40 and mentioned something about it, but we'll look at that later on. So smash the like button for me and share the video with others. Let's reach as many students as possible watching the live stream and watching the playback as well. I want to hear from you in the chat box. If you have any questions, there is something you want me to go over or you want me to clarify, you can put it in the chat box because I'm reading all of your comments and we'll be replying to all of your comments. So smash the like button if you are getting some values on the video today, and then let's get more engagement on the video so that we can reach as many students as possible. If you have not subscribed to the channel also, make sure you subscribe to the channel. That way you will be notified when I go live every day. Alhaji Jalo, I see you. Oluwa Tobi Ayai, he said, yes, sir. Okay. Brian Kapatuka said, hello, sir. Hi, Brian, sorry. Nicole Williams said, Happy New Year. Said, many happy returns, Nicole. I hope you're doing well. It's been a while hearing from you. I hope you're doing well. Matundi Leonard said, hi, bro. Happy New Year. It's awesome to hear from you again. Many happy returns. Kapatula. No. That is Kapatula. No, that's Leonard. Sorry, that's Leonard. Many happy returns, and I hope that you are doing well. Welcome to the live stream. Thank you very much. Thank you very much. I see some of you smashing the like button for me. Thank you very much. Thank you very much. That way we get more engagement on the video and we can reach as many students as possible. Remember, my objective for doing this live stream is to provide you with the assistance that you need so that you can be in a better position for you to be able to go into the exam or squash the exams, pass the exams, and most importantly, take your life to the next level. And there are a lot of people who are not getting access to lectures like this. So when you share the video, you help us to get more access. When you hit the like button, the video become more engaging, and then YouTube will be able to push it so we can reach as many students as possible. So thank you very much for the support. I really, really appreciate it. Fashina said, thank you for the content. I'm really learning. Please, I'm a bit confused as to what you mean by capitalized cost. Okay. What I mean by capitalized cost is about the borrowing cost. You know, I will deal with IAS 16, IAS 23 later on, though, and the borrowing cost. But the interest expenses and the cost we incurred in the arrangement of the loan, not all qualify to be capitalized as per IAS 23. So the amount of the borrowing cost that qualifies to be capitalized in accordance with IAS 23 is what has to be capitalized. It's what will be included in the initial cost of the asset. So like I mentioned, when we get to IAS 23 and we are talking about the capitalization period, the non-capitalization period, you'll get the understanding in that case. So that is the concept about that in relation to that. I hope it makes sense. Fashina, let me know if it makes sense to you. Enoch Kwame, great, thank you. Welcome. Patrick Edu, welcome to the live stream. I see some of you joining. Thank you very much. Now, remember, we started our lectures for the May 2021 examination yesterday. So you can enroll and study directly online with me and join our weekly Zoom sessions and get access to all the lecture videos, the ebooks, the question kits, so I can hold your hands to pass the examination. So you can visit NhyiraPremium.com. You can see the link pinned to the chat box. You click on it and go online, enroll in a course, make payments, and then be able to join us so that I can assist you to prepare well for your examination. Right, so after the initial recognition, we move on to the next one, and that is called subsequent measurement. Now, at the initial recognition, let me state this before we move from this slide. Let me state this. Once we get the initial amount of the assets, double entry will come to town. So we're going to debit property, plant, and equipment like this. Make sense? And then we'll credit cash or payables or provisions. You got to be careful what's going on here. So you got to be careful what's going on here in relation to that. Now, so you debit PPE and then credit what? Cash. You can credit payables. You can also credit provisions, depending on what is going on there. You credit cash when you have already made a payment. So you finish with the payment and then you credit cash. Or if the amount is outstanding, then you have to credit payables. That is a liability. Or better still, if you did provisions like IAS 37, the dismantling cost, then you have to credit provisions and do the unwinding. I hope you get the idea. So that is the initial double entry. Jacob, I saw your question, but for some reason you deleted it. So maybe restate it. You were talking about the training cost. So you can restate it and I can answer you in that case. I won't comment on it because you are deleted it. Probably you want to restate it. So let's go to subsequent measurements. Subsequent measurement. Now, on subsequent measurement, IAS 16 states that among other things, an entity should account for the assets either using the cost module or the revaluation module. Okay? And this is where the journey is going to become more interesting. So stay with me carefully here. So on subsequent measurement, we can either use the cost module or the revaluation module. So two modules can be used to account for assets on subsequent measurement. Now remember, we are talking about owner-occupied assets here. Now, the cost module is where the asset is carried at its historical cost. Okay, the asset is carried at its historical cost, meaning that the amount at which we bought the asset or we manufacture the asset, we carry it there. Then with that, the carrying value will be equal to the cost of the asset minus any accumulated depreciation or impairment. Okay, the cost of the asset minus any accumulated depreciation or impairment. Now, under the revaluation module, stay with me carefully. I'm going to come back to the cost model in a moment. This is where the asset is carried at its fair value. Okay, this is where the asset is carried at its fair value. Now, please note that about 99.9% of the time, assets will really be carried on subsequent measurements using the revaluation module. Why is that? That is so because of the fact that when it comes to non-current assets, the standard states that at least once a year, assets should be revalued. So technically, a lot of assets will be carried at the revaluation module rather than at the cost module. And I'm going to come back to that in a moment and clarify something to you in there. So under the revaluation module, it is where we are carrying the assets at the fair value. Now, when we say the fair value, what does it mean? According to IFRS 13 fair value measurement, fair value is simply the value at which an asset can be exchanged or a liability settled in an arm's length transaction between market participants. Should we take that again? According to IFRS 13 fair value measurement, fair value can be defined as the amount at which an asset can be exchanged or a liability settled between within an arm's length transaction between market participants. So the value at which we can exchange an asset. So what if I have this phone and I want to give it to you, and in exchange of money, the value at which I'm going to give it to you, it's the fair value. If I owe you $10,000 and you say, oh, Nhyira, pay me $9,000, then the $9,000 becomes what? The fair value. We will look at IFRS 13 later on as we build our knowledge in relation to that. Then with this, the carrying value of the asset, or the carrying amount of the asset, will be the fair value minus any accumulated depreciation and any impairment in the asset. And we'll look at this in a moment and build the knowledge much there in that case. So the cost module and then the revaluation module. With a cost module, we are carrying the asset at its historical cost or at its initially recognized amount. Then with the cost module, the carrying amount or the carrying value of the asset will be equal to the cost of the asset minus any accumulated depreciation. The cost of the asset minus any accumulated depreciation and impairment. Under the revaluation module, the asset is carried at fair value. And the fair value of an asset is simply the value at which an asset can be exchanged within an arm's length transaction between market participants. And then the carrying value or the carrying amount of an asset, of the asset under the revaluation module, will be the fair value minus accumulated depreciation and any impairment in that case. So what do we have in relation to that? The key question we ask ourselves is, when can we use which method? Okay, so when can organizations say, oh, okay, I'm going to use a cost module for this asset? When can an entity say, I'm going to use the revaluation module for this asset? When can an entity say, I'm going to use the cost module? So this is what we see. Because fair value is about market availability, stay with me carefully. Stay with me carefully. This is something you need to understand. Because fair value or the revaluation model is about market availability, the standard states that when there is a ready market for an asset, okay, and there are market participants, then we can recognize the asset using the revaluation module. So when there is a ready market for the product, okay, and there are active market participants, that means that we can carry the asset at its what? Fair value. We can carry the asset at its fair value. But where the asset has no ready market, if the asset is of a specialized nature, then we cannot account for the asset using the revaluation module. Instead, we will carry the asset using what? The cost module, and carry the asset at its historical cost. I hope you get that. So you don't just get up and say, oh, for this asset, yeah, let's use the revaluation module. For this asset, let's use the cost module. No. If the asset is a specialized asset, it's a customized asset, it's an asset that someone else cannot use off the bat without great modification, then the asset should be accounted for using the cost module, where we account for it at the historical cost, and then on subsequent measurements, either test for impairment or depreciate the asset if it is a depreciable asset. However, if there is a ready market for that asset and there are market participants, people buying that asset, people selling that asset, then we can carry the asset using what? The revaluation module. I hope you got that. That's very, very important. So we don't just get up and say cost module. We don't just get up and say revaluation module. But like I said a moment ago, you must note that the standard states that assets cannot be carried over their recoverable amounts. Hence, once a year, at least once every year, all assets must be revalued to reflect their true fair value in the books of the organization in that case. I see some of you coming on. You are welcome to the stream. Augustine said, hello guys, hope you are all good. Yes, Augustine, we are good. I hope that New York is good as well. Harry G. Mulba is with an emoji in there and a thumbs up. Samuel Quason said, greetings. Thanks for always assisting us. Always a pleasure, Samuel. Samuel, your results is still hanging. It will be released soon from the ICA's new website. The results, they said the results coming soon. So keep your fingers crossed. Possibly by the end of this week, the results will be released. Ario said, hello, good evening. Hi, Ario Temitope. Forgive me if I don't mention your name right, okay? Thank you for joining the stream. Smash the like button if you are getting some value from the video, and share the video as well with your friends on WhatsApp, on social media, Facebook, and everywhere. Let's meet, let's get to as many students as possible. Now, one thing stands out, okay? One thing stands out in this particular thing. Okay, someone said, yes, please, hoping for the best. Definitely hoping for the best. Now, one thing stands out here, and you can see depreciation. Depreciation. So let's talk a little bit about depreciation. But before I go into depreciation, there are other things that I would want to help us understand and define, and that's going to be depreciation, amortization, impairment, and depletion. So these are 4 key things that you need to understand when it comes to dealing with assets. Okay, when it comes to dealing with assets, these are 4 key things that you need to really understand in relation to that. Depreciation, amortization, impairment, and depletion. Depreciation, amortization, impairment, and depletion. Very critical. Now, when we say depreciation, depreciation is simply the annual allocation of the cost of the assets over its economic useful life. In other words, depreciation is simply the amount that is charged on an asset for its usage within an accounting year. So usually depreciation deals with tangible assets. Okay, tangible assets. If it's about a tangible assets, then we would depreciate it. So the annual charge of the cost of the assets, the annual charge for the usage of the assets in generating the economic benefit is what we refer to as what? Depreciation. Amortization usually is used mostly for intangible assets. So we don't depreciate intangible assets. Instead, we amortize them. So things like development cost, it's amortized. Things like franchise acquisition, it's amortized over its economic useful life. So amortization has to do with, again, the spread of the cost of an intangible asset over its economic useful life. The spread of an intangible asset over its economic useful life. Impairment will be dealt with under IAS 36 later on. Impairment, we'll deal with that later on. But impairment simply is when the recoverable amount of an asset is less than the carrying value of an asset. In other words, if the carrying value of an asset is greater than the recoverable amount of an asset, we said the asset has been impaired, or the asset has suffered impairment. So when we are carrying the asset at, say, 3,600, but the recoverable amount of that asset is, say, 2,600, then the asset has lost value. The asset has reduced in value by 1,000, and that is what we mean by impairment. Please note that tangible non-current assets suffer impairment, and then intangible assets also suffer impairment. So under IAS 36, we'll be looking at the idea about impairment later on for you to see how assets are impaired and how they are looked at. Then depletion is the loss in value of an asset due to wear and tear or old age. So depletion is a loss in value of an asset due to wear and tear or old age. So because you've used an asset for a long period of time, it wears out. So when it wears out, it has depleted in relation to that. Or there is a disaster, there is a flood or something like that, and the assets suffered something by flood or natural disaster or something like that. All those will be defined as what? Depletion. Like I said, under IAS 38, intangible assets, I'll be talking to you under amortization. Under IAS 36, impairment of assets, we'll be dealing with impairment later on. Depletion is not something that we're really going to be excited about mostly in our discussion. So let's zoom back to depreciation. Any questions, please put it in the chat box, put it in the comment box. If you have any questions, let me know. If there is any clarity that you want, anything you want me to clarify, please put it in the chat box. I want to hear from you guys in that case. Mustafa Buka said, I'm enjoying this. That's also Mustafa. Alex Hammond said, with an emoji there. Mustafa said, thank you. But Igwams with an emoji also there. Thank you very much. So let's go. Depreciation. Now, there are various methods of depreciation that you must know about when it comes to dealing with tangible non-current assets. There are various methods of depreciation. But for the purpose of my presentation today, I'm going to, among other things, talk about 3 of the methods of depreciation. The first one is going to be the straight line method. Let's write that well, Nhyira. So the first one is going to be straight line method. Second one, it's the reducing balance method. And then sum of year digits. So these are the 3 methods that I'm going to be talking about for the purpose of my presentation. I want to talk about these 3, sum of year digits. So straight line method, reducing balance method, and sum of year digits. Okay. There are other methods, okay, like the production value method. There are other methods though, but these are the 3 core that I would want you to make sure you understand and know how to treat them very well, because they are going to be playing key roles when it comes to the way you understand the standards and the way you actually pass the exams in relation to that. So let's look at them. The straight line method of depreciation or approach of depreciation is where the asset is depreciated over its economic useful life. In other words, the same amount of depreciation is charged over the life of the asset. The same amount of depreciation is charged over the life of the asset. So maybe let's take it one after the other so that I can write well. So straight line. So with a straight line method, we are saying that it is where the asset is depreciated over its economic useful life and the same amount of depreciation is charged. So same depreciation charge over its economic useful life of the assets. In other words, what happens here is that the depreciation is also charged on the cost of the assets. The depreciation is charged on the cost of the assets. So we charge the depreciation on the cost of the asset. Now I'll explain this statement to you in a moment why I am saying that. So the reason why I'm saying it's charged on the cost of the asset is that sometimes when it comes to the depreciation, the examiner will give us percentages. So the examiner will say 20% straight line. So if the examiner says 20% straight line, that means the depreciation figure is simply going to be 20% of the cost of the assets. Okay, 20% of the cost of the assets. That is what we mean by depreciation being charged on the cost of the assets. Formula purposes, we say that the annual depreciation will be equal to the cost of the assets minus the scrap value or terminal value divided by the economic useful life of the assets. Okay? Annual depreciation will be equal to the cost of the asset minus the terminal value or the scrap value divided by the economic useful life of the asset. That is a straight line method. The same amount of depreciation is charged over the life of the assets. The depreciation is charged on the cost of the assets, and then the depreciation is going to be the cost of the assets minus the scrap value or the terminal value divided by the economic useful life of the assets. In other words, in some instances, you may not have the scrap value of the assets. So if you don't have the scrap value of the assets, then directly the annual depreciation is going to be the cost of the assets divided by the economic useful life of the asset. That is simply what we mean by the straight line method. Very simple, sweet, straight to the point. Very simple, sweet, straight to the point. Now let's look at the reducing balance method. Now, with the reducing balance method, this is what happens. So reducing balance. So with reducing balance method, this is what happens. What happens in the reducing balance method is that depreciation is charged on the carrying amount of the assets. On the carrying value or the carrying amount of the asset. So unlike straight line method where we charge depreciation on the cost of the asset, with a reducing balance method, we charge depreciation on the carrying value of the assets. In other words, under the reducing balance method, depreciation reduces as the asset ages. So the depreciation charge reduces as the asset ages. The depreciation charge reduces as the asset ages. The depreciation charge reduces as the asset ages. And then 3, our depreciation is going to be the percentage will be given to us. So the examiner could say 25% reducing balance basis. So that will be given to us. So once that is given to us, we're going to be using that multiplied by the carrying value of the assets in that case. Multiplied by the carrying value of the assets in that case. So that is what we mean by reducing balance. So the depreciation is charged on the carrying value of the assets. Depreciation is charged, or the depreciation charged, that is the annual depreciation charge, reduces as the asset ages. Okay, the annual depreciation charge reduces as the asset ages, and then the annual depreciation charge is going to be the percentage given to you multiplied by the carrying value of the asset. Multiplied by the carrying value of the asset. Then we come to the double entry. So annual depreciation usually will be debited to either accumulated depreciation or debited to the profit or loss account. Okay, so we debit the profit or loss account, and then we will credit the property, plant, and equipment with the amount of depreciation that is charged. So when we say debit PPE, it means we're going to either add it to cost of sales or add it to administrative expenses, depending on what the question said we should do. Usually depreciation on plant is taken to cost of sales, whilst depreciation on building, it's spread between cost of sales and administrative expenses in that case. So we debit P&L, meaning we treat it as an expenses, and credit PPE, meaning that you deduct it from the PPE so that you can get a carrying value that will be taken to the statement of financial position. So that is also about the reducing balance method. Any questions, please put it in the chat box for me. What have we discussed so far? Number one, we've spoken about the objective of the standard. We've spoken about the recognition of the standard. We've spoken about that is the recognition criteria. We spoke about what should constitute the initial cost of the asset. We've discussed what is not supposed to be included in the initial cost of the asset. We've shared some thoughts on the issue in relation to the subsequent measurement, the cost module, the revaluation module, and we are now looking at the methods of depreciation. We've looked at the straight line method, which we said that the same amount of depreciation is charged over the economic useful life of the assets, and then the depreciation is charged on the cost of the assets. And number three, the depreciation will be equal to the cost of the asset minus the scrap value divided by any economic useful life of the assets. And we are saying that under the reducing balance method, depreciation is charged on the carrying value of the asset or the carrying amount of the assets, and then the depreciation charge reduces as the asset ages. Okay, the depreciation charge reduces as the asset ages, and then the depreciation, it's always equal to the percentage multiplied by the carrying amount or the carrying value of the asset in relation to that. And the double entry is that we debit PPE, and then we debit profit or loss account, we debit profit or loss account, and credit property, plants, and equipment. Now I see some comments coming in. Christian Vibe said, great works, thank you. Eric Asumenin said, God bless you, amen, God bless you too, Eric. Jacob Apia said, wonderful, great. Abdul Salam Salifu said, hi Nhyira. Hello Abdul. Thank God we are back at it again. Yes, definitely we are back. I hope you're doing well, Abdul. So let's look at the last method of depreciation, and that's going to be the sum of year aggregates. Actually, the sum of year aggregates method just works like the reducing balance method. In other words, high amount of depreciation is charged in the early years of the assets, and the depreciation reduces as the asset ages, which makes a lot of sense because in the initial stages of an asset, you know the asset is productive, the capacity is very high, it can work for long hours, but as the asset ages, the productivity of the asset reduces, and it is for this reason why the sum of year aggregates will be used. But this is the concept about the sum of year aggregates. It's where we're going to be using a formula, a method to be able to represent what is being done in relation to that. So here, this is what happens. This is what happens about the sum of year aggregates. I'm going to just pull up a simple illustration and use it for the concept in that case. So let's say that we buy an asset, and the cost of the asset is, say, $30,000. Okay. And the economic useful life of the asset is, let's just say, 5 years. So this is how the sum of year aggregates works. This is how the sum of year aggregates works. So we're going to have the year ended somewhere. So we can say 20x1, 20x2, 20x3, 20x4, and then 20x5. Okay, 5 years. Then this is what we're going to do. The one will be 1, 2, 3, 4, 5. Then when we finish, we sum all of them up. Stay with me carefully. Stay with me carefully. We sum them up. So 1 plus 2 is 3. 3 plus 3 is 6. 6 plus 4 is 10. 10 plus 5 is going to be what? 15. In that case. 15 in that case. So that is the idea in relation to that. So 1 plus 2 is 3. 3 plus, so you are doing cumulatively, okay? 3 plus 3 is 6. 6 plus 4 is 10. 10 plus 5 is 15. There is another way you can obtain this figure by using the formula. I think this should be the formula. So that's going to be, the n represent the number of years. So 5 into bracket, 5 plus 1 exponent into bracket 2. So that's going to be 6. 5 plus 1 is 6. 6 times 5 is 30. 30 divided by 2 is 15. So you could use this formula as well to obtain the total, so that I don't have to go through the schedules. Because if the asset has a life of 50 years, then you can't write 1 up to 50. You can simply use the formula and go away. But this is where it becomes interesting. So how do we actually get a depreciation? The first year, the depreciation is going to be 5 over 15 times the cost, 30,000. The second year will be 4 over 15 times 30,000. Third year will be 3 over 15. Fourth year will be 2 over 15. And fifth year will be 1 over 15. So that is how you charge the depreciation. So let's work out the arithmetic. Let me grab my calculator real quick. All right, so let's go. So let's see. So 5 over 15 times 30,000. I'm getting 10,000 on that. So that's the depreciation, 10,000 here. Then we have 4 over 15. That's 8,000. Then we have 3 over 15. I think that should be 6,000, and it will follow in that order. Yeah. 6,000, 4,000. And then 2,000. And that will add up to what? The 30,000. So that is the idea about the sum of year digits. So you realize that the depreciation figure reduces as the asset ages. The depreciation figure reduces as the asset ages. And that is the idea about the sum of year digits. So these are the 3 key methods that you need to understand when it comes to depreciation of an asset. The straight line method, the reducing balance method, and then what? The sum of year digits. The sum of year digits. Let me know in the comment box if you have any questions for me. Mohammed Kabia said, hey, Nhyira, what's the scheduled days for F7? Like we structure the lecture based on what we are covering and the questions we receive. So you can follow me on Instagram, and the meeting details, the daily meeting details will be posted there. But this whole week will be dedicated to the IFRS standards or the accounting standards. So throughout this week, you can join the stream 4:30 p.m. or 16:30 GMT in that case, PM, and join in that case. So the whole of this week will be dedicated to looking at the accounting standards, and you can follow me on Instagram. Meeting details will be posted there. Tyron Ayon said, I'm also doing F7. Okay, so that applies to you. Akunda Melan said, thanks for the good work, Nhyira. Always a pleasure, Melan. Tyron said, sir, I don't know if you are done with IAS 20 because I'm late. Please explain the whole process and the whole process of a reversal in both cases if you haven't taught yet. Thank you. Yeah, we've not done IAS 20 yet, government grant. Possibly tomorrow I'll be touching on that as we continue in the live stream. So you stay connected on that, and we'll be continuing in that case. Right, so that is what you need to understand when we talk about the issue in relation to these. Ario said, does it mean that we do not use asset cost of carrying amount for sum of year digits? No, as far as we are just giving the cost of the assets, like say 30,000. Now, certainly assuming that during the year or as the year goes by, the asset is revalued and the useful life of the asset changes, then whatever revalued amount will be used to perform this schedule. Okay, whatever revalued amount we have will be used to perform the schedule. So assuming the asset was revalued, then whatever revalued amount will be used using the remaining useful life of the asset to determine the depreciation to be charged. So not only that, we will always be using the cost. I'm using the cost here because we are starting from scratch. But if it is a continuous business or it's a continued asset, then we wouldn't be using the cost. We would rather be using the revalued amount or the carrying amount of the asset in that case. So that is how we deal with it in that. Let me know if there are other questions real quick in relation to that. Tyron said, sir, your Instagram ID, it's Nhyira Premium, the same name on this channel. Nhyira Premium, the same name on the channel. So we've been able to cover so far the issues about recognition criteria, initial recognition, initial cost, subsequent measurement, and then the methods of depreciation. Methods of depreciation. The next thing is to talk about revaluation. Revaluation of assets. Revaluation of assets. Now, when it comes to revaluation of assets, that's also a very huge area. This is where IAS 12 can come to town, that is income tax can come to town in that case. But I'm going to be touching on that, God willing, tomorrow as we continue with the discussion. For time constraints, we've started our lectures on campus. So we have lectures in a few minutes. So for time constraint, I'm going to be concluding here today. Thank you very much for joining the stream. It's always a pleasure coming your way. If there are any questions you have, anything you want me to share my thoughts on, put it in the comment box, put it in the chat box. Remember, I'll be coming your way 4:30 p.m. each day, Monday to Friday. And this week, we are dedicating it to the accounting standards, doing the IFRS masterclass. God willing, tomorrow, I'm going to touch on revaluation of assets. Then we'll start solving some questions here in the ICA question kit. So for those of you who have it, even if you don't have it, I'm going to be sharing the screen with you so that you can take a snapshot of the question and be able to put it down. I'm going to also post that question on my Instagram page, so you can follow me on Instagram if you're not following me already on Instagram. Thank you very much for joining the stream. It's always a pleasure coming your way. Thank you for the thumbs up on the video. Thank you for sharing the video. Thank you for the comments in the video, and thank you for the support. We really appreciate what you do and how you help this channel to grow. We are heading towards 10,000 subscribers, and gradually we will get there, and then we will be focusing on other things as well in that case. Please know that we've started lectures for our ICA May 2021 examination, and you can visit NhyiraPremium.com and enroll in a course today. You can call or WhatsApp +233 050 114 9296 +233 050 114 9296. If you have any questions, you can send us a hi on WhatsApp, or you can call us directly, and we'll be able to answer any questions you have or provide you with any queries that you need in order for you to prepare well for your examination, and most importantly, pass your exam. So thank you very much. I'll catch you same time tomorrow at 4:30 p.m. as we continue with the IFRS masterclass, and that will be section 3. We'll be continuing with the IAS 16, solving some questions in there, and then it will jump to IAS 20 and then IAS 23 also in that case. So thank you very much. Stay safe, take care of yourself, until we'll meet again tomorrow. God bless you and stay blessed. Bye-bye.